Welcome to the Deep Dive. Today we're taking a look at a stack of sources that honestly feel like they shouldn't exist in the same universe.
It's a pretty wild mix. On one hand, you have hard asset rallies and major global economic shifts.
And on the other, a deep dive into personal wellness strategies. Our job today is to pull the signal from all that noise for you.
Yeah, our source material is a financial commentary package from January 2026. And what's really stunning is the scope. It jumps from, drone strikes and central banks buying gold.
To why you absolutely need to schedule time for self-care in your calendar.
Exactly.
So our mission today is to extract the really crucial trends from late 2025. We're talking about the explosion in assets like silver, the very surprising strength in Canadian stocks.
Which is happening alongside some real economic weakness there. It's a paradox.
It really is. We'll also get into the pushback against centralized control and, critically, why managing your own well-being is now, well, fundamentally linked to managing stress in this kind of volatile world.
It really is the essential modern question, isn't it? How do you manage your portfolio when the world is fragmenting? And how do you manage your own sanity when the news is just relentlessly chaotic?
Okay, let's unpack this. This material paints a remarkably dynamic picture of what's shifting right now.
We have to start with the geopolitical backdrop. It didn't calm down in 2025. It really intensified.
Right.
The sources highlight some specific events, things that signal really high-stakes friction. Notably, Ukraine carrying out a drone swarm attack on Putin's residence.
And that's a direct escalation. I mean, markets can't ignore something like that.
They can't. And at the same time, on the, let's call it the information front, the U.S. made a very pointed statement.
About free speech.
Yeah.
Yeah, they banned 5 figures tied to European censorship from traveling to the U.S.
Which is a clear signal. It's saying we're willing to confront our own allies over who controls speech and information online. Sovereignty isn't just about money anymore. It's about who controls the narrative. And all this instability is happening while the U.S. economy is reporting, red-hot numbers. They hit plus 4.3% real GDP growth for the third quarter.
And China's official line was that its economy was on track to hit its 5% growth goal for 2025. So the big players seem strong on the surface, but
underneath, there are these huge structural shifts happening.
But the biggest one the sources identify is this accelerating de-dollarization trend. The data shows the share of U.S. dollar assets held by other central banks.
Okay.
It's just cratered.
It's dropped to the lowest level since 1994.
1994. Just think about that. That's a 30-year structural reliance on the dollar that is actively, and it seems deliberately, being unwound.
Absolutely. And the BRICS countries are clearly in the driver's seat on this, strategically shedding their U.S. dollar and treasury exposure.
And what are they buying instead?
Gold. They're moving into gold and other hard assets.
So when you see the dollar's reserve share hit a 3-decade low, is this an emergency or more like a slow structural bleed?
It's a slow bleed, but it's becoming more and more predictable. It's not a sudden collapse. It's a systematic, a loss of confidence.
So what does that mean for you, the listener?
It's the first major signal that you should probably be considering a portfolio that hedges against the dollar's dominance, especially if most of your wealth is in dollar-denominated assets. Central banks are diversifying. Maybe you should be too.
Which brings us right to the assets that have just skyrocketed from this shift. Silver. It's surged to new all-time highs. The number is just unbelievable, a 140.95% year-to-date return at the end of 2025.
It's a staggering number. And when you see that, the first question is always, is this a bubble?
Right.
But the sources suggest the underlying demand is actually structural. Gold also surged, of course, because of all that central bank buying we mentioned.
And the report made a very interesting note about Canada, that they hold, 0 of these official gold reserves?
None, which is a choice.
The silver rally, though. The ratio between gold and silver really backs up the value argument, doesn't it?
It really does. That ratio, how many ounces of silver it takes to buy 1 ounce of gold, it dropped from 105 to 1 down to 62 to 1.
And 62 to 1 is the lowest it's been in over a decade.
11 years, yeah. That drop is the structural signal. It suggests silver was just extremely undervalued compared to gold for a long, long time, and the market just corrected that imbalance aggressively.
And it's always the case that the price moves first and then the media narratives catch up.
Exactly. After the 140% move, then you start reading all the articles about, structural supply deficits, industrial demand from solar panels, EVs, AI data centers.
All the geopolitical risk factors.
Right. All true, but the smart money was moving way before those stories became common knowledge.
So why now? Why are hard assets having this moment?
Well, the sources identify a few key drivers. It goes beyond just inflation, though that's part of it. It's really about an erosion of trust in fiat currencies.
Fueled by real-world examples.
Yes. Fueled by seeing assets actually get frozen. We saw it happen in Canada with the protests. We saw it with Russian sovereign reserves. When people see that their digital or paper assets can be confiscated for political reasons.
Physical sovereign assets start to look a lot more attractive. It becomes an essential hedge.
Precisely.
Okay, let's pivot from gold to something a bit stranger. The Canadian stock market is one of the biggest anomalies in this whole report.
It is. The Toronto Stock Exchange was what the report calls a serial underperformer for something like 14 years.
Just lagging the U.S. year after year. But in 2025, it showed, and I'm quoting here, significant outperformance and strength. The TSX composite was up almost 29%.
A massive reversal.
Yeah.
Now, the sources are quick to add some context. On a long-term chart against the U.S., it still looks like a downtrend.
You have to, what do they say, squint to see the new uptrend.
Right, you have to squint. But that performance, plus the fact that it's noted as being less volatile, it should make investors take notice.
But how do you reconcile that strong market with the on-the-ground reality in Canada, which seems, well, disastrous?
It's a huge disconnect. You're seeing falling house prices, developers going bankrupt, GDP per capita is declining.
And food bank usage is surging. It's a real cost-of-living crisis.
And that crisis was fueled by that massive, almost 60% expansion of the money supply back in 2020. That's what laid the groundwork.
So the big question is, why didn't the Canadian stock market, which is over 30% financials, just implode with the housing market?
It's a great question, and the sources have a clear answer. The financial sector has been incredibly resilient because they've insulated themselves.
Oh.
They've offloaded a lot of the risk using government entities, and crucially, they're leveraging the post-financial crisis bail-in legislation.
We should probably unpack that for people. The bail-in concept is different.
It is. It essentially allows a big bank in a crisis to use the capital of its shareholders and even certain depositors to recapitalize itself.
Instead of a taxpayer-funded bailout.
Exactly. It shifts the burden of failure onto private creditors. And because that legislation is in place, the market is confident that the financial sector can actually handle a lot of housing loan issues without a full-blown collapse.
That insulation is just key to understanding the market's stability.
Right.
Okay, so moving away from Canada for a second, we're seeing long-term yields rising everywhere, right? This isn't just a Canadian housing problem.
No, it's a global bond market shift. U.S. long bonds, if you track an instrument like TLT, they've just been crushed, down 51% over 6 years.
Wow.
The whole idea that central banks can just easily engineer a return to ultra-low rates, that looks pretty flawed right now. Long-term yields are structurally higher, which means the era of the sub 2% mortgage is definitively over.
And finally, a couple of assets that didn't do so well. Crude oil was called the eyesore in the report.
Yeah, down 19% year to date, just stuck in a downtrend.
And for the first time in a while, Bitcoin actually posted a negative one-year return, down about 6.7%.
Let's shift gears a bit. Let's talk about the philosophical idea that connects all this financial anxiety. The concept of sovereignty. The sources draw heavily from a book from 1997, The Sovereign Individual.
It's amazing how relevant that book still is.
Yeah.
Written before, the modern internet or AI really took off. It argued that governments are always spending beyond their means, always seeking more control.
And its core arguments really resonate today. Things like states introducing exit taxes for people who try to leave, or the hidden tax of inflation hitting everyone. It frames the relationship between the state and the citizen as one of increasing friction.
And we see that tension play out in a really modern digital frustration that's detailed in the source.
Yeah, this story is something else. An individual was blocked for months from accessing ChatGPT.
And it wasn't a government censor. The culprit was their own internet provider, Rogers.
Their own paid provider, using so-called advanced security to deliberately block their access to a tool they needed.
That story is so powerful because it's the modern bureaucratic nightmare. You're paying a company to block your own tools. It shows that your digital sovereignty, it's subject to this layer of corporate gatekeeping.
That's it, exactly. It's not just the government anymore. But, technology can also be part of the solution. The commentary mentioned using a newer AI tool, Grok conversationally while driving.
For productive tasks.
Yeah, for research, planning a trip, practicing vocabulary, all hands-free. It's a way to integrate this technology to reclaim your time, to become more efficient, which is actually a pretty good segue to our last topic.
Right. So given all this chaos we've talked about, surging silver, blocked AI access, it makes perfect sense that the sources shift focus to personal strategy, to resilience and wellness.
This is such a crucial pivot because stress is the natural output of all this volatility. And the key takeaway here is from something called the SMART program stress management and resiliency training.
And the insight is so simple, but so brilliant.
It really is. It's the importance of physically scheduling your self-care time.
It's not enough to just intend to do it. You have to block it out in your calendar like a client meeting.
Yeah.
The source mentioned a participant who committed to 1.5 hours every single week.
And intentional is the key word there. This can't be just, mindless scrolling on your phone.
Right.
It has to be dedicated to things that genuinely reduce your stress. Meditation, exercise, a hobby. If you don't schedule it, your ability to manage everything else on your plate just starts to degrade.
And that idea of regulating your body leads directly to a really practical tool they mentioned, using a sunrise alarm clock to fight that winter grogginess.
I love this. It's such a great low-tech solution for a high-stress world. Instead of a jarring noise, the clock just uses light. It gets progressively brighter over 40 minutes or so.
To gently signal your brain that it's time to wake up.
Exactly. It mimics a natural sunrise, which helps regulate your circadian rhythm. If you're living somewhere where it gets dark at 4 p.m. in the winter, this can be an incredibly powerful tool for just feeling better.
It's all about building personal resilience.
So if we synthesize all of this really diverse material, the two big takeaways for you, the listener, they really center on one theme: the search for sovereignty, both financial and personal.
On the financial side, you can see that search for safety and value accelerating the shift into hard assets and non-U.S. equities. The portfolio in the source material reflects that. It's about 37% Canadian equities, 36.7% U.S., and nearly 11% foreign.
A much more global, balanced approach. And then on the personal side, amid all the chaos, sovereignty over your own time and your own mind is paramount.
You have to prioritize it. You
Yeah.
have to physically schedule that self-care time and commit to it.
Absolutely. The world is clearly looking for safety in these shifting dynamics.
And that leads us to a final provocative thought for you to consider.
We saw in the source material that governments are talking about things like exit taxes. We saw that a private company you pay can already block your access to a critical digital tool like AI. So if your access to information can be subject to that kind of centralized control, what further risks does our increasing reliance on purely digital currencies like CBDCs pose? Their benefits are always being promoted by governments trying to maintain confidence, but if your internet provider can block ChatGPT.
What stops a central authority from blocking or at least conditionalizing your digital wallet?
Exactly. Something to think about as you plan your intentional hour of self-care this week.